just like the bank on the corner can't start making a profit by lending money out until they take some in, you can't enjoy the benefits of borrowing money from your dead self until you've paid some in. So there's a little bit of a waiting period. But boy, once you get down the road with this thing and you realize everything you can buy and either pay back or not pay back, it's great. But it does take some capitalization. It takes some patience on the front end.
From Goalpost Studios in downtown East Lansing, Michigan.
Hello and welcome to the Earn More, Keep More show,
where it's our job to give you tips, tricks, and strategies to earn more and keep more. I'm Dave McAndrews, and I believe that we should focus our marketing on messages that are all about our clients so that we can connect with them in a way that they can understand. Welcome to the Earn More, Keep More show, where it is our goal to teach you tips, tricks, and strategies to earn more and keep more. And today we have a very special guest. Matt, why don't you go ahead and introduce our guest for our audience?
I would love to introduce this guest. So I have known this guest for, Bryan, when did I meet you? 2011?
It was when you were a little kid.
Yeah, I was a little kid. I had a lot more brown hair.
A young buck.
My hair wasn't nearly as great. It was 2011 when I just got into the financial industry, and I saw Bryan speak, and I immediately called my father, who was he had been in the business 30 years at that point. And I started talking about this CPA guy that actually wasn't boring. I go, this is the first CPA I've listened to who's not boring, and he actually has a lot of interesting things to say. And it turns out Bryan's been in the business for a long time of doing tax returns and some financial planning. And I've been a long-time fan of finding a CPA or a tax advisor that does tax planning rather than just a tax return. And Bryan exemplifies that. He has a number of books out, but with no further ado, Mr. Bryan Bloom, welcome. I'm excited to have you, Bryan. Bryan's written 3 different books on, what are they titled?
We got them right here, actually. We got Confessions of a CPA, What If What I Was Taught to Be True Had Turned Out Not to Be, Confessions of a CPA. This is the Confessions of a CPA series. The second one is the Truth About Life Insurance, and then the third is the Capital Equivalent Value of Life Insurance. So just give us a little bit of a background on the books, Bryan.
And yourself, please. I mean, talk a bit, just a touch on how long you've been in the business and who you are, why you do what you do.
No, I've been a CPA practicing for over 35 years. And you can imagine during that period of time, I've done my fair share of income tax preparation. And it was really curious. As I got older, so did my clients. And I found myself doing tax returns for people who are 85 and 90 years of age. And I started asking myself, gosh, when is enough enough? I mean, come on, by 85, haven't you paid more than your fair share? And so that was the first thing that bothered me. The second thing that bothered me was I was being asked by the U.S. government to obtain the official signature of people in that age range that probably had no idea what they were signing.
Yeah.
And yet I was charged with that responsibility. So that began this inquiry of mine into the Internal Revenue Code to find out why what I was taught to be true wasn't.
Amazing. So you're talking about people that are long past retirement age, getting closer to triple digits, and they're still required to file not only file tax returns, but to pay taxes on assets that they might have had for decades.
Yeah, I mean, think about it. They're paying taxes to pave the roads they can't even drive on anymore.
It's unbelievable. It's unbelievable. So you took a turning point when I think your first book, What If What I Was Taught to Be True Turned Out Not to Be True? Confessions of a CPA. What's the gist of the main gist of that book?
It was the second half of my discoveries, and that was why were my own personal finances not looking like the graphs and charts that I found in my finance books when I was being taught how to do all this. You see, theoretically this all worked, but practically it didn't. And so that's what that first book is about, is why what I was taught to be true wasn't.
Give me, in a short 2-minute answer, what's the biggest takeaway from that book?
Einstein's an idiot.
Ah, I love it. I knew you were going there. I'm glad you did. Continue.
But he coined this phrase, the eighth wonder of the world is the miracle of compound interest.
Yes.
No, it's not, because you missed it by one little word, uninterrupted. The only way compound interest exponentially grows is if you don't spend it. If you spend it, you interrupt it. If you interrupt it, you don't get anywhere near what the book shows.
If you spend it, you reset that compounding curve. And if the market goes down, you've reset the compounding curve, even if you don't enjoy it personally.
Yeah, I mean, anytime that exponential curve takes a dip south, it's going to take a dip south exponentially.
Yeah.
You see, there was a year where the growth of my investment portfolio, or at least the taxes due on the growth of my investment portfolio, I couldn't personally afford. I just couldn't write them a check. Now I had the money, it was in the investment account. So I took the money out of the investment account, paid the taxes, but then I exponentially lost the value of those taxes. I didn't just lose the $1,000 I took out of the account, but I lost what that $1,000 could earn for the rest of my life.
Yeah.
That was my exponential experiences in what I didn't have, not in what I did have.
Yeah.
I'm going to bring up a name. There's a guy that's very famous that does, I call him a financial entertainer, and Dave Ramsey.
Yeah.
And Dave Ramsey is very good for a lot of Americans, and I am not going to say that he's not. I think he does a very good job. I think where he's missing the boat, though, is that if you follow traditional planning, that compounding curve is what all advisors talk about. That's also what they get paid on, to manage that money. And when you use it in retirement, not only have you killed that forward momentum, like you just said, you've lost that money out in the future. You're resetting it from scratch, so that your legacy, like the people you're leaving your legacy to, they're also going to be hurt by that.
That's exactly right. This is not just during your lifetime. This is generational losses.
Yeah, I like to say that principles, when it comes to financial principles, they don't change. Principles, what is that saying? Principles are few, methods are many, principles are few. Methods always change and principles never do. That works when you're, accumulating wealth, going up the mountain, and it doesn't change when you're coming down the mountain, when grandma and grandpa start to spend their money. And so you saw these, elderly people filing tax returns, not even being that aware or, competent. Like you said, they couldn't drive a car. And they're required.
No, they weren't. You see, the tax code only requires you to pay a tax during your lifetime on the money you earn. When you trade your time for someone else's dollars, that's mandatory. Every other tax in the code is voluntary. Now, why is someone who's 85 still paying taxes? Because they screwed it up when they were earning. They decided they didn't want to pay their taxes when they were due. They wanted to pay them sometime down in the future. Well, guess what exponentially grew there? Well, it wasn't their money, it was their debt to the IRS.
Yeah.
And they're still paying for it when they're 90.
So
the IRS got compounding interest there.
And specifically, you're talking about tax deferrals. So every CPA
No. Hang on. No, wait. No, that's the nice word. Tax deferred.
Okay.
Isn't that sweet? Oh, it's tax deferred. Oh, nice. A better word might be tax postponed. Now, it means the same thing, but doesn't it sound a little different? I think something postponed sounds a lot more onerous than something deferred. But in all reality, it's a debt. It's a 4-letter word. It says you owe people money. Now, no one thinks about tax deferral as a debt to the U.S. government, people who break legs when you don't pay it.
Well, my CPAs have always told me that, oh yeah, you want to defer as much as you can. That way you don't have to worry about that today, because in the future you're going to be in a lower tax bracket. It won't matter as much to you. And
so there's a couple problems with that. Number one, they told you to defer your taxes because they wanted to do your tax return next year. You see, if they could save you taxes this year, you're going to hire them again next year.
Oh, it's the subscription model.
Yeah, it's for their benefit. It's not for yours. And if you think about it, if you're going to be in a lower tax bracket when you retire, the only way for that to work is to fail.
I love that line. That's so
True. Say that again.
The only way for tax deferral to work is for is for your financial plan to fail.
So what you're saying is the only way for you to actually succeed in this plan is to live on a smaller income than you had while you were working. So you're required to take a step back. You are required to live on less or fail in order to succeed.
Yeah, start thinking today what you're going to do without the day after you retire. Are you going to stop golfing more? No, you're probably going to go golfing more. Are you going to stop getting your hair done? No.
Well,
Dave doesn't have that problem.
I stopped a while back, but that's something different.
Are you not going to go see the grandkids?
Yeah, that's
You
it.
see, we need more money in retirement, not less.
Every day's a Saturday in retirement. This is a controversial opinion here, so it's my own opinion. It's not the opinion of the show if we're being recorded here. So the financial industry gets paid a fee based on an account value. Why on earth wouldn't they want to manage pre-tax dollars instead of post-tax dollars? If I have pre-tax dollars that I can fund or defer inside of a qualified retirement account, the investment advisor then gets to charge a fee on a higher dollar amount. The client is required to pay a fee on the IRS's portion. You want proof? Pull the money out. A portion of that money is going to go to the IRS, and they have not sent one payment to that advisor to manage that money. But you better believe that they're going to collect on the back end.
Yeah, I mean, don't we pay the IRS enough? Now we got to pay their investment fees on top of it?
It's crazy. So without diving too much into that, because that's a whole nother rabbit trail, I want to talk a little bit about Bryan Bloom and all of your thoughts and how you got to where you are. What do you enjoy most about? Let's back up. What do you do today? What do you do for a living? And then what do you enjoy most about what you're able to do? Because I look at you as you're kind of, in my book, you're semi-retired. You're just enjoying life now.
Oh, I am. My wife says I should stop confusing my office for the golf course.
I like it.
Now, what I do today is I train financial planners. I do hands-on, on-the-job training with them and their clients, and we expose their clients to these principles. But my main focus is the advisor, so that they come to understand why what they've been taught to be true isn't. So that's what I spend my time doing. And, I am the master of my calendar, so I am retired, and I do this because I really enjoy it. I mean, it's kind of hokey to say, but I really do. And some people's office is their golf course. I get to do whatever I want to do whenever I want to do it. I think that's being retired.
I would agree with you. Willie Nelson was asked one time, Willie, when are you going to retire? He goes, I travel the world and I play music. Retire from what? Now, we travel the country and work with people all over the country and show them how to have more money for the rest of their lives generationally just by understanding the tax code. That is fulfilling. I can't imagine from retiring from that either. I heard you're going on a trip soon.
I am, in a week.
How long are you going to be gone?
A month.
That sounds like a man who's retired.
That's pretty good retirement right there.
We're going to tour Europe for an entire month.
See, that's how you retire. You don't retire and live off of ramen noodles at the house and not go anywhere. You want to go travel and see the world.
Costs more money than any vacation I've ever taken before. It's a good thing no one told me I was going to be in a lower tax bracket.
Thank goodness. Thank goodness.
Well, they may have told you. You just didn't listen to them.
Well, that's true.
You did the research on your own and dug into the financial code and figured out what was actually true. So
maybe I should say I'm glad I'm not in a lower tax bracket. Or maybe better yet, I should say I'm glad that the cash flow that I enjoy today isn't taxed. So therefore, I am in a lower tax bracket, but I'm spending more money than I've ever spent in my entire life.
I love it.
Now, that's success.
And when we make a clip of this, we're going to have legal flashing across the screen. Cash flow, off the radar, legally. It's understanding the cash flow. I love it. I think it's brilliant. And I think more people want to know how it works. Unfortunately, the financial industry gets paid to take our dollars and lock them up in an investment that they can control. And they don't, like our audience, Bryan, is filled with business owners. We've had a number of entrepreneurs and business owners in on the show that we've interviewed and talked about their practice. And most of the feedback we get is all from business owners. They can get a better rate of return by investing in themselves. Most business owners don't put a lot of money in the stock market. I always joke the stock market's for two types of people: wealthy people to park cash, and not wealthy people who think they're going to get rich. And so it's not a long-term strategy, it's just a parking place. But when we understand cash flow from a CPA like you, I've worked with you for 9 years now, our clients then realize, gosh, I can keep my cash in a place that can generate massive cash flow, no market risk, no taxation, no fees.
Yeah. And cash flow does not go on the income tax return.
Let's talk a minute about your final book, because we could probably go on. We could make this too long of an episode without even trying. But let's talk about the last book, which I find the most interesting. The last book you wrote, you call the capital equivalent value. Is that term?
Not yet. It's hard because it's hard to convince people that it's not commonly used. And it's just because it's misunderstood. It's actually a calculation that has never existed until the publication of that book. You see, we look at rate of return from start to finish. It's called an internal rate of return. But you see, there's a midpoint. Because if you don't get to the midpoint of an investment, it may not last for the rest of your life. So from your retirement date forward, that screws up the whole thing. So if you don't have enough money on the day you retire, well, then your cash flow after retirement is going to be less. So you have to have a measurement of the capital equivalent value. What value do you have to have on retirement date in order to retire successfully? And so life insurance is a very difficult asset to value. It's what they call a hard to value asset. And so you can only do it by finding a bogey or finding some other investment, some other asset that you can stipulate a value to, and then being able to ascribe that value to the life insurance. So for instance, the real true value of life insurance is in its cash flow, in its off the radar screen of the IRS cash flow in retirement. Well, great. So what you have to do then is you have to back into what you'd have to have invested anywhere else to give you that same benefit that the life insurance cash flow is going to give you. That's called the capital equivalent value. Now all you have to do is consider what you've been investing in order to achieve this fictitious number in some other investment, and do the math, and that's the rate of return that's necessary. And Matt, what you find out is that in a life insurance contract, you would have to earn easily double digits anywhere else during the accumulation years in order to give you the same outflow that a life insurance contract is going to give you. So that's capital equivalent value, and the book goes into it in fine detail.
I'm going to say it one more time. You would have to earn at least double digits every single year, year after year, to have an account value that would duplicate the net income that an insurance contract could give you.
The net cash flow.
The net cash flow that an insurance contract could give you. You know,
Never call it income, because if it's income, you owe the IRS money.
It's very true.
Right.
Very true. The book that I'm working on, Brian, I think you know this, is called Gross versus Net. And it talks about, what's our goal? We're saving money because eventually we want to be able to spend it. Well, then why are we not focusing on the spendability, and we're always focusing on the account value? And my theory is, well, the financial industry gets paid on the account value. They don't get paid on showing you how to spend it. There's not a 401k administrator in the country that's required to teach their clients how to spend the 401k.
That's when you get the junior advisor. All of a sudden you get an advisor change on your account because now you're taking money out and the old guy doesn't get paid as much, so he brings in the new guy to help you spend it.
Isn't that sweet? And then they sell the book of business, and then they enjoy retirement much differently than their clients ever do. I've always wondered, financial advisors have really nice cars. I always wondered how that was.
So Brian, I was first introduced to your work by another advisor. Hindsight Financial. That's right. We had Mark Tomei on the podcast a few weeks ago, and he gave me your book, and I took that book with me on a camping trip, and I managed to read the majority of that book over the course of 2-3 hours on an afternoon in a hammock. And the best
It's a
thing,
nice way to do it, right?
it is a
I'm
really good
looking
way.
at snow, rain outside.
Yeah,
right now.
not great, but it's a nice way to do it. But one of the biggest things, the mental picture that you painted was that of, going up the mountain versus going down the mountain. And I'm 40 something now, and no one had ever talked to me about the other side of the mountain, what to do going down, and how that interacts with, how to think about that. It had only been about grow the pile of money as big as you can so that you can live off of the interest. And that vision of giving people a way to get down the mountain in an intelligent way, that you can actually have cash flow, that you can actually enjoy that time of your life, was a very different message than I think anybody out there really is preaching. So I definitely appreciate my time in the hammock with you.
I got worried there when I heard you were taking my book on a camping trip. I have visions that you might have used the pages for something else.
Nope, not kindling, only kindling for the mind.
Yeah. So that's phenomenal. So the capital equivalent value, I think, has had a heck of an impact in me and my clients, and obviously Dave's life. What have you seen in the response after writing that thing? Have you had other advisors reach out to you, or other CPAs reach out?
Yeah, I have. It's interesting. Over the series of the 3 books, I have never had as much public response to the first 2 as I have the 3rd one. I've got retail readers of my book, because it's available on Amazon, contacting me, figuring out how to find me by email or phone, and they're asking me to help them implement what they've read in the book, because they've never heard anything so clear and concise before in their lives. So this one's had a lot of retail type of response. Advisors, it's who I really market the book to, because I truly believe that this book in the hands, or I should say 20 books in the hands of an advisor, is going to create more momentum for the type of thinking change I want to affect in the world today. So, advisors are my ambassadors, so to speak, but it's amazing how much retail comment I've had.
I love it. I know that I've used it with my clients, and I like that the industry is starting to look at stuff that's just not mainstream. And this isn't to say 401ks and deferred plans are bad. They're really, you can't make blanket statements like that. But there's a lot of people looking for answers that this book answers. That this book really identifies, because I think the industry does a really good job of making everything confusing. Not only on the investing side, look at the tax side, right? I mean, how many pages are in the IRS code? Too many. I think there's like 70,000 or something. It's incredible. Who has time to read it? They're expecting us to make a mistake. We are entitled to milk every single page out of that book and take advantage of anything in there. It is not the IRS's responsibility to teach us what's in that book. And if we make a mistake, sorry.
Yeah.
Well, they don't call it a mistake, they call it fraud now.
Very good point.
You don't know what you don't know.
So when we talk about earning more and keeping more, understanding how to file taxes and save taxes in the year that you file is one thing. Arguably, at least just as important, if not more important, is how to minimize taxes for the rest of your life. Last time I saw you, we sat down in the back of a room and we were talking about income-based taxation. Types of taxation that only becomes effective if you show an income. Meaning this. Where you keep your assets will affect how many taxes you pay in the future. In other words, you could be building an account hoping to get a big pile and minimizing what you're entitled to at the same time. And here's my little asterisk, and the person who manages the big pile, they're not going to be the one to tell you this.
No, and I was just casually making a list of benefits and things that are going to be tested by your income in the future and be taken away from you over time. And just casually, I came up with 14 of them. 14 benefits that you will not get if you show too much income on your income tax return.
Do you want to share some of that list?
Sure. Did you know that there's a 0% capital gains rate?
No.
No. We all think there's a 20% capital gains rate, and that's pretty good. But if you make too much, that's when you pay the 20% capital gains rate. If you can minimize your reportable income, you don't owe any taxes on your capital gains.
What?
Now, I'm not talking about being poor.
Does an amount of, yeah, you're talking cash flow. I mean, I could live on 500 grand of cash flow and I could be in a 0% capital gains bracket.
Yes, yes.
Does the amount of, and this is a technical question, but does the amount of capital gains affect that?
Yeah,
Okay.
it does. Yep.
But
So you
my
gotta-
income
Will also affect it.
Yeah, it's like, sitting in a tub of water with a whole bunch of ping pong balls and you're trying to keep them all underwater at the same time. And as you push one down, one comes up the other side. You got to balance all this out. But if you don't even know about it, how do you keep that ping pong ball submerged if you don't even know about it?
Yeah.
But nobody knows about this.
Give me a couple more.
Your Social Security is taxed twice.
That's a big one.
Just stay on that for a minute. That's huge.
Yeah, man, our country was founded 240 years ago on the principle of taxation. We were upset because the British government charged a tax on tea and we didn't have any say in it. And we started a revolution. Now today, if you make too much money in retirement, you owe taxes on your Social Security. Well, that's nuts. Because you've already paid taxes on the money when the money went into Social Security. Now when it comes out, it's taxed again.
Wow.
That's called double taxation. And no matter where you're living today, listening to this podcast, I'll bet you your senators and representatives know all about that.
Yep.
That would be called double taxation with representation.
With representation.
Yeah.
Yes. I've met so many clients that are getting ready to retire. They're expecting X amount from their retirement funds and X amount out of Social Security. Well, they're not getting X. That X is a pre-tax amount from Social Security. Once the IRS steps in, they're entitled benefit. They're entitled to Social Security if they paid in. Now they're required to pay tax on that. And the interesting.
Yeah. Now, Matt, we're a different generation. Okay, I'm older than you are.
By many years. Many years.
Here's my advantage. The taxes on my Social Security, if I don't pay attention to it over my retirement years, is going to be about $250,000. The taxes on your Social Security, if you don't pay attention to it, is going to be well in excess of $1 million. And I can quantify that number every day. $1 million, Matt.
That is very sobering.
Now, would you like to keep it?
I'd love to keep it.
If I could show you how to keep that kind of money in your pocket during retirement, when you want to talk.
You're actually talking about a number, $1 million, that a lot of people are hoping to get to. And you're talking about it as just that number that you can either keep or not keep, depending on what you do with it after you earn it. So essentially, a lot of people out there have the potential of, if their goal was to get to $1 million, if they could do something like this, now you've doubled the amount of money. And to put on top of that, going back to the capital equivalent value of life insurance, $2 million has a capital equivalent value of something like $5 million.
Higher.
Exactly. Now you're on it.
Okay. That's a amazing differential in a retirement plan just by knowing how to do it correctly.
And I'm going to say it a different way than Brian. You say it a third way. I would say $2 million in a properly structured life insurance plan will give you the same, if not more, benefit, cash flow to your family than $5 million in a 401k or an IRA. Brian, how would you say that?
Let me ask you that. So if $2 million in a life insurance contract will give you the same benefits as $5 million in a 401k plan, which investment did you have to take more risk to accumulate?
Oh, hands down, the 401k.
Yeah.
Which one did I enjoy more? I mean, let's talk about. I'm a big happiness guy. I believe there's a rate of return in happiness. No one teaches me how to enjoy my 401k. That's for this event when I retire and I get old, like Bryan. I don't know how long that's going to be. Life insurance. You can pull out life insurance before you even get to retirement.
Sure. Well, yeah, you're just spending your dead self's money. That's all you're doing. That's a concept, huh? How'd you like to spend your death benefit without dying?
I love it. I talk about this with the way I bought I have a sports car, and I'm also having a baby. So thank you, honey, for letting me buy the sports car before we have a baby.
That's the last one.
Well, that's not going away when the baby comes out either. So just so you know. But I always tell people, I say, look, I have insurance in force. If something happens to me, my wife and family are taken care of. It's guaranteed. The value of my Jaguar came from my dead self. So if I die, my death benefit's reduced by the value of my Jaguar, but my wife still gets the car. So it's the net legacy that I pass on is the same as it would have been, and I get to enjoy my Jaguar. That's why I call it my retirement plan.
Here's a good one, Matt. Do you have time for another story here?
Yeah.
So you and I have a mutual friend by the name of John.
Yeah.
You know who I'm talking about.
Where does John live there? Is he up north there? Does he live up north?
He's an Eskimo.
He's an Eskimo. All right.
But anyway, so John calls me from Orlando. He's down there at Disney World, and he's hemming and hawing about whether he should buy into the Disney Vacation Club because it's going to cost him $40,000 to buy into this vacation club. And he's worried about the money he's going to spend. So I said, okay, John, think about this. Now you've been embracing these ideas. You own life insurance, and Maria owns life insurance as well, right? He says, yeah. I said, when are you going to get Maria's death benefits? He says, I'm not. I'm going to die first. And I said, so why not go take $40,000 of Maria's death benefits right now and go buy into the Disney Vacation Club, and you can enjoy the death benefits you're not going to get by going on vacation with your family every year.
That seems like a really good. How do you quantify that rate of return?
You don't.
With little kids in Mickey's hands and with meeting Goofy and with little ear hat, you can't. How do you quantify? My 401k never did that.
So John buys into this thing with money he's never going to get.
Oh my gosh, I love it.
Cash flow. So you're telling me cash flow is off the radar of the IRS for income tax purposes.
Yeah. Well, Matt, let me ask you this: if you recently bought a house, right?
Yeah.
Did you take out a mortgage?
A big one.
Big one. Did you have to show the proceeds of your mortgage on your income tax return as income?
I sure did. I did not at all.
No, you didn't, because it's called what? A loan.
Yeah, debt.
If you want to spend your death benefits, the only way you can spend your death benefits legally is by dying, and then you don't get to spend them anyway.
Yeah.
But if you borrow your death benefits, you can spend them without dying, and if you borrowed them, they don't go on your income tax return. Tax exempt.
Exempt from tax.
It's been in the code. It's been in the code for 105. You know, a lot of.
And does it actually go on your return as a interest payment?
No. A
Nothing.
lot of advisors are always out there trying to crack the code. If they just read the code, they'd find out all this is just in the code. You don't have to crack anything.
Yeah.
Unbelievable. So you take money against your dead self, and then I know how this works. The insurance company is still paying you dividends as if you had never taken the money.
Right.
So you know that the death benefit's still going to be there, and you get to enjoy it while you're alive.
Yeah.
And there's zero taxes, zero market risk. There's no waiting till age 59 and a half to access that money.
It's yours.
What business owner doesn't want to know this stuff exists? Unbelievable. I just love this business that we're in.
Yeah. Isn't it cool?
I think it's great. Dave, you think it's cool?
Well, as soon as I get a little bit more capital value that I can actually borrow against,
it gets fun.
Yeah, I'm excited for that.
I love it.
Dave, that's the hard part about all this, is just like the bank on the corner can't start making a profit by lending money out until they take some in, you can't enjoy the benefits of borrowing money from your dead self until you've paid some in. So there's a there's a little bit of a waiting period. But boy, once you get down the road with this thing and you realize everything you can buy and either pay back or not pay back, it's great. But it does take some capitalization. It takes some patience on the front end.
And really, what got me most interested in this is the fact that I have 5 children. Right now, they're between the ages of 8 and 14. And so at the time that I first started learning about all that you guys do, my daughter was 5 years away from starting college, my oldest daughter. And so I very much had in my mind, okay, how am I going to pay for college? And I had already started setting aside some money and had some of that money in the market and that sort of thing. But when I saw what you could do with this, with the loans from this type of policy, and the fact that, obviously I'm a small business owner, and there's a pretty good chance that somewhere down the line I'm going to buy or sell or one or multiple businesses over the next 10, 15 years. And the fact that when I had that liquidity event, I could have borrowed money essentially from myself to help fund my children's college education, and then turn around and drop money from a liquidity event back into that policy and regain all of the interest that I would have earned had the money been in there the entire time. Yeah. And once that was explained to me, I was like, why wouldn't I do that?
No brainer.
Yeah. Right. And I think that there's a lot of our entrepreneurial class out there that something like this really makes a tremendous amount of sense. And in some of your other books, you go pretty deep into different ways to buy out a business. If a business owner is looking to retire, they're trying to figure out how to give it to their employees in a way that they can still benefit from financially and make it so that it can happen. There's some really interesting things
look at the way
that you go into in those books.
Yeah, and look at the most highly compensated employees in the country. Bank executives, NCAA sports coaches, professional sports coaches, some of the wealthiest entrepreneurs that we know of, congressmen, senators, they pay themselves just like this. Mm-hmm. They're not doing what the common investor is taught. They know the rules of the game because they're at a different level. I'd love to emulate what they do.
Can't beat that.
No. Well, Bryan, thanks for being on the show today. I really appreciate it. I think this is a good episode. I think that a lot of what you bring to the table in these 3 Confessions of a CPA book, all of which can be found on Amazon, right?
All 3 of these are really good, but
My favorite, I'm going to vote Capital Equivalent Value.
It's awesome. Well, thanks for having me this afternoon, and I'm just glad to be part of it. Anytime you want to have an encore performance, I'd be glad to join you again.
Fantastic. Well, we'll definitely have those books linked up on the website at earnmorekeepmore.show. And so go ahead and check out the website. We will have all of that information on the episode page, and hopefully a lot of entrepreneurs that are out there that are looking for something that is clear, that is simple, that gives a plan that is really a lot better than some of the other financial products that have been thrust upon us or advertised to us our entire lives.
Absolutely.
We really want folks to take a look at that and see what some of those options are, that there are some really solid people such as Bryan Bloom who have done the homework to figure out where is it in the tax code, how can we take the best advantage of it as we can, because honestly, as Americans, and Bryan, as you said, we are a country founded on not paying excess taxes. So it is our God-given right to figure out how to not do that.
How to keep more of your wealth and give less away.
Drop the mic.
Well, thank you for listening to the earnmorekeepmore.show. Do not forget to hit that subscribe button below so that you can make sure you're up to date on all the new episodes. And if you want to be a guest, we would love to hear from you. On our website, we have an easy downloadable form where you can put in your information and share with us your experience of how you've turned a problem into a process.
We are all about our listeners, and we want to make sure that our listeners are finding a place. And we are most excited for you guys to share with us how you are earning more and keeping more. We look forward to hearing from you.
This has been a Goalpost production.
That's it for us. We are your hosts, Dave McAndrews and Matt Love. Our executive producer and creative guru is Jennifer McKinstry. Our social media director is Mark Farnes. And a very special thank you to Lansing's own Jose Moore for providing the music.
Thanks for listening.